Welcome to the weekly review of the markets from Hernandez Retirement Services. This is Agustin Hernandez. This week, I will focus on the results of the S&P 500 index for the week ending November 30th, 2018. I will continue to use the 40-week moving average, but I will reintroduce the 10-week moving average plus add a new indicator, the MACD histogram. Later, with the focus of the world markets in Argentina for the G20 over the previous weekend, I thought it would be interesting to see what the global equity markets are doing. I will go over several of the G20 broad equity indices and see if they are doing better than us. And finally, I will give you my take on where we are and where we could be headed. Before we begin the charts, the opinions voiced in this material are for general information only. All performance reference is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Technical analysis is the forecasting of future financial price movements based on an examination of past price movements and cannot predict the future. Technical charts reference are subjective. No strategy can ensure success or protect against loss. Investing involves risk, including loss of principal. Let's begin. This is the weekly chart of the S&P 500 index over the last 52 weeks. I am using the candlesticks for price, with red candles representing a negative week and a transparent and green representing a positive week. Now, one new item below the price chart is the MACD histogram. What is the MACD histogram? It is the moving average convergence divergence histogram, according to Investopedia.com. It is an invaluable tool that helps investors profit from momentum. In these charts, the green bars are for positive momentum weeks and the yellow are for negative momentum weeks. Now let's put all the indicators together for the S&P 500. In this chart, I have also included the 10-week moving average, the blue solid line, and the 40-week moving average, the black dotted line. The 10-week moving average is used for a faster trend indicator, while the 40-week line is used as a longer-term trend indicator by traders. So let's look at the price chart first. On the far right, we see a big solid transparent bar which indicates a strong positive performance by the S&P last week. And the weekly results back the candle up as the S&P did rise by 4.85%, which is good. But despite that, price is kissing the 40-week line. I would like it to start the week not only above it, but close above its long-term 40-week line. Another thing of concern is that the 10-week moving average is very close to falling below its 40-week line. That's not good news, as it will result in a death cross. That is a negative indicator that forms when its quicker 10-week line goes below its 40-week line. So based on price and moving averages, we are not out of the woods yet. Now, below the price chart, we see the bars are yellow. And as I stated from the previous slide, yellow is negative. In fact, we see that there has been negative momentum in the S&P since early October. And despite 4 weeks of being positive, momentum has yet to turn positive. So in this chart, for a positive move up, I would like to see price fight to get above its 40-week line, the 10-week moving average turn around and begin to slope up, and the MACD histogram to turn green. With this chart, we begin the Around the World tour. We begin with Brazil, as it is the largest stock market in South America. I will be using all the same indicators and time frame I used with the S&P. As we can see on the left, the MSCI Brazil Index started off well. It had a nice run up at the beginning of the year until March, where it began to show some weakness. During that period, price went below its 10-week moving average on negative momentum. With the MACD continuing to show negative momentum, price fell below its 40-week moving average. And in May, the dreaded death cross happened. Since then, this broad equity index has found support and has been trying to get back into strength. The positives are that it has gotten above both its 10-week and 40-week moving averages, and the MACD turned green, which is positive. But we must be cautious, as the 40-week moving average is still sloping down, and also the MACD histogram is beginning to lose some strength. So for now, there are some positive signs in Brazil, but more work will be needed to get truly back in a strong rally. Now, in this chart, I will be looking at the MSCI Australia Index. As the S&P in Brazil, this broad market index started the year well, but it also showed weakness in February, where it went below its 10-week moving average and suffered a death cross in March. Now, there was an attempt to get back to an uptrend from late April, but that rally stalled. Now, price did get above for a brief period its 10-week and 40-week moving averages, and the MACD did turn green. But the key here is that the 10-week moving average could not get above its slower moving average despite positive momentum. Unfortunately for the markets from down under, a new downtrend began and further losses were sustained. As of last week, the MSCI Australia Index is showing major weakness as price and the 10-week moving average continue to be below the 40-week moving average, and momentum is also negative on this chart. But there may be some hope for the Aussies, as though momentum is negative, the yellow bars are getting smaller, which gives hope for a new positive trend. Now we go to our neighbors to the north. How does the MSCI Canada Index look? Pretty much like the Australian Broad Index, in fact. From left, we can see strength at year ending 2017. But there were struggles in early 2018 with price breaking below the 10-week moving average and the 40-week moving average within several weeks. Weakness was confirmed as the MACD indicator turned yellow during this time. Now, like the previous chart, we can see an attempt to break out of its negative situation. And in fact, not only did price get above its 40-week moving average, but also the quicker 10-week moving average as well. But that was short-lived for the land known as the Great White North. It could not break above a price channel that started in May, and then momentum and strength broke down. Right now, this broad market is in true weakness that needs lots of work to get back into strength. One of the biggest stories heading into the G20 was what would happen with China and the US. Well, here we look at the Dow Jones China Broad Index. Here we can see nothing but weakness. Why is it happening? Who knows? Slower growth, trade war with the US. What is important is what the chart is telling us. And what is the chart telling us? That this is not a healthy broad market. Like the previous country indices, weakness began early in the year, and in March, this market hit the death cross and has not recovered. Here, the rallies have trouble getting and staying above the 10-week line, let alone the longer-term moving average. And momentum for the most part has been yellow, which is negative. Here's where investors of this broad market really must be careful. The last several weeks have shown momentum begin to turn positive, but this index has so much bad technicals to make up that any failed rally can lead to bigger drops. In my previous video of the S&P 500 of 2007-2008, we saw the index drop like this chart and try and make attempts to rally until all strength was gone and a true crash happened. This market has a lot of work to do to get back on track, and one should proceed with caution. Here, the MSCI France index shows that even in Europe, there is no hiding from the global equity market struggles. Here, we see the French broad equity market struggling but staying afloat until May, when true weakness begins to show up. First, we see price hitting the 40-week line at the same time as momentum is beginning to get weak. Even after a brief rally several weeks later, price began and has stayed below the 40-week line. It also experienced a death cross in late June as the quicker 10-week moving average crossed below its 40-week line. There has been brief rallies, but it seems to be the 40-week moving average is the line of resistance. As we look at the NYSE ARCA Japan Index, weakness began early for this broad market. There was a brief rally in the spring when price and the 10-week moving average got above the 40-week line. That did not last long. Once again in September, another rally failed as price was able to get above the 40-week line, but the rally was not strong enough to get the faster 10-week moving average above its slower line. Now we can see a downward slope for both the 10-week line and also the 40-week line. Now, what about our neighbors to the south? The NYSE ARCA Mexico Index has not been healthy all year. The 40-week line started the year above both price and the 10-week line, which is not good for the market. Again, one would prefer the quicker moving average above the slower one for an uptrending market. Now, this market did have some fight to it as it rallied in the summer to not only get price above its 40-week line, but the 10-week line finally broke above the slower line. But this was short-lived, and weeks later, both the price and the quicker moving average fell below the long-term line. The final country we would like to look at is the United Kingdom. Here, its S&P-led index shows a roller coaster ride. Like many of the other charts we looked at, the year started strong, but soon weakness hit this broad market. Now, John Bull did have some gusto and led a rally to top the previous high early in the year. But if you can see on the MACD bars, the green bars began to shrink, which means that positive momentum began to wane. Soon momentum turned negative, and that led this market to begin breaking below its moving averages. In October, the death cross was completed. Now, the key here is whether this market has hit a bottom. For now, the line of support is the lows in March. If it can hold and it begin a new rally, that would be good news. What investors from across the pond do not want to see is price break below this support line. For technical traders, breaking a line of support can lead to real negative results. So, what does this mean? Well, to keep it simple, the global equity markets are struggling. No area of the globe has been spared. Now, our US equity markets were the strongest and held strong until recently. With most of the world markets struggling in a technical sense, such as their prices being below their 40-week moving averages, it would be wise to be very cautious. Now, we do see some pockets of possible uptrends in both Brazil and the US, but there still needs more work to be done before they become uptrending markets again. So the key is to be patient and let these markets prove to you that a new uptrend is on the way. I would like to thank you for for viewing this video, and I hope it was helpful. Please subscribe to my channel for future videos.